Have you ever wondered what happens to the economy when the stock market crashes? Well, let's delve into that. You see, the stock market and the economy share an intriguing connection. They're like two sides of the same coin, each reflecting the other's state. Think of the stock market as a mirror reflecting the health of an economy. When companies are thriving, generating profits, and expanding, stock prices rise. This rise is a positive signal, an indication of economic growth and prosperity. On the other hand, when companies are struggling, when they're not making profits or are even losing money, stock prices tumble. This fall is a negative signal, a reflection of economic stagnation or decline. In essence, the stock market acts like the pulse of the economy, giving us vital signs of its well-being or ill health. Therefore, a stock market crash, with plummeting prices, can often be seen as a symptom of a sick economy. But how exactly does a stock market crash impact the wider economy? Well, it all starts with a tumble in stock prices. This tumble is not just a fall on a screen, it's a decrease in the perceived wealth of millions of investors. This decrease can make people feel less wealthy, and thus more reluctant to spend. A reduction in consumer spending can hit businesses hard. As revenues decline, businesses might find it necessary to cut costs to stay afloat. One common way to do this is through layoffs. And here's where the ripple effect truly begins. As more people lose their jobs, consumer spending decreases even further. This can create a vicious cycle, a downward spiral that can potentially lead to a recession. So you see, a stock market crash is not just a Wall Street problem, it's a Main Street problem too. In essence, a stock market crash can send shockwaves throughout the entire economy. So, to summarize, the stock market and the economy are deeply connected. It's like they're two sides of the same coin. The stock market isn't just a place where shares are bought and sold. It's a mirror reflecting the health and vitality of our economy. When things are going well, the stock market thrives. Businesses expand, jobs are abundant, and consumers spend. It's a virtuous cycle of growth and prosperity. But when the stock market crashes, it can send shockwaves through the economy. Consumer spending can decrease, businesses may lay off workers, and the specter of recession can loom large. In essence, a stock market crash can trigger a chain reaction, affecting everything from your local grocery store to global corporations. It's a sobering reminder of the interconnectedness of our financial systems. But don't be disheartened. Knowledge is power. Understanding this relationship is key to understanding the complexities of our economy.